time, the market's going to move 15 pips or more. So when you're looking at Hercules, I don't know if everybody has seen the videos. In the Hercules videos, I talk about the graph moving at 1 point or more. And what we're looking for on the graph is very similar to what you would normally be seeing on the screen. Can everybody see where my pointer is? And you've got the red and green lines are pushing down, and they're getting deeper and deeper, and then all of a sudden they just go away. Well, what we're doing in the background here with all the math, and part of the reason why this is kind of buggy is we're doing quite a bit of calculating on the back. Well, what we're doing is looking at all of the currency pairs. This is the euro-US dollar, but we're looking at every euro currency cross as well. Because the tendency in the market is, as professional traders move, is they don't just buy the euro because they know if they want the euro to go up, it's going to go up, number one, against the dollar, but it's also going to go up against everything else. Plus, they have to spread their money around. They'll have some guys which are executing the euro-US dollar, some that are executing the euro-Japanese yen. Okay, so they spread the love. And part of it is so that they can actually get the bloody order executed. You know, when you're trying to buy 500 million euros, as big as the Forex market is, that's going to be difficult. And here's why. You can't confuse the Forex market. Okay, we all know the Forex market is huge, right? Trillions of dollars a day. You all know that that's not done through one bank, right? Okay. The reason why a firm is going to have to go out to multiple banks is because even though there are trillions of dollars, it's spread out over 250 or 260 banks. So you can, even a trillion, if you divide it by 260, you're going to have some guys that transact more, some guys that transact less. Now, everybody here knows when you buy something, someone has to sell it to you, right? When you go to the hotel at lunch, they have to sell you the sandwich in order to buy it, right? Right. We're going to do another whoa yes here, right? Right. Okay. Now, it's easy to forget that. When we're sitting in front of our screen and we're looking at this, it's not readily apparent that there's some banker sitting somewhere who's actually selling to us or buying from us. So you have to remember that when the Japanese researchers were looking at the data, they were looking at what the actual bankers did. What did they trade? So as we distill this down, there we go. Is that? Nah, that's not big enough. Hold on. Forgot for a moment that they won't let you clone lines, and wouldn't that be nice? If you could just click on it and say, give me another one of those. They're Russian.
What data are you measuring by your graph at the bottom?
Hold on. Write that down for me, because that's a good one for the Q&A. So how many of you know that I talk about zones, right? When you're looking at support and resistance, you have to look at a space in time. Okay, it's not, for the engineers, a discrete point. It's not a point on the chart that you go, boink, price stops there. And it's because we're a mass of people, right? We've got thousands and thousands of people that are mucking around in the market and making their opinions known. So the key that we run into, or I'm sorry, the hurdle that we run into with the markets then is, where's it going to stop? How big is the zone? I mean, how many of you have seen me talk about support and resistance zones that are 300 pips wide? Yeah, that's frustrating, right? Okay, sure, I'll just put it on somewhere in there. Well, and there are some traders who do that, and it is possible to trade that way. So what we're looking to do is narrow it down. So we take it from the big chunk. Okay, we have 100 pips or 200 pips that we're looking for in the marketplace for the market to stop. What we need to figure out is where in that area are we most likely to see a reversal. Okay, now for the discretionary trader, meaning the person who can kind of look at the market and wants to, figure it all out. Let me go to the overhead. We'll talk about that. I had to leave that up there. Good morning. Okay, there's your zone. Now, what you hear me talk about in the video is, well, when price gets in there, look for something, right? But it's that something that can be frustrating. Well, what does it look like? If the chart, is that really a pennant? I don't know. Maybe it's a flag. What should I do? Well, what we're looking for here, if price is going up, what are our two options? We can either buy or sell, right? We need to know which one's the better option. Well, if we have price moving up, what do we want to do? Okay. If we think price is going to go down, we need to sell. Okay. So what we talk about in the kit is put your buy order there, sell order there, hope for the best. Right? Well, with Hercules, what it will give to you. And just so everybody knows, we're just going over the background stuff. We'll get into it more here. That actually reminds me of something. Let me digress for a moment. Yeah, no, you get from the, he's not going to do that. He never does that. I think the trouble we all run into is time, right? Some of us have more than others. And I'm very aware of that. You understand? That's why I'm producing a lot of these shortcuts for you. So as you're using these pieces of software, they are going to have some limits. They're not going to be a cure-all, but the aim is to give you a shortcut. Remember the metaphor of the guy that wants to learn carpentry. So back in the 1500s, he'd go to the guild master and probably camp out on his doorstep with 25 other guys trying to be carpenters, and they kept it limited, and they wanted to make sure that you'd really be dedicated, and you had to jump through all the hurdles and hoops, right, to learn. Well, the aim here is to shortcut some of that, but the foundational stuff is still important. So what you're going to see, Cecil and I, the interplay that we have, what I want to give you is the perspective from the market maker. What tactics would we do to take your money? And all of it, if we could. I'm sorry, but that's just the way we thought. It's when we would smell blood in the streets, you'd go after it. The reason why you see Amaranth Capital, how many of you have heard of Amaranth Capital? A few? Amaranth Capital was a huge hedge fund up in Canada. One trader lost them roughly $5.5 billion in a week. 1 week. Okay, so if you have questions about how much should I have in my account, well, start with 6 or 7 billion and you should be okay. Well, I say that jokingly, and if you had money with them, you have my sincerest condolences. The problem was the guy didn't understand trading. What happened? He was the biggest fish in a small pond. Well, the problem with the markets, it's not like real ponds, okay? Us fish, we can jump into other ponds. And if I see a big fish in a small pond and he's bleeding, I'm going to paddle my way over there, jump on the land, flop over, get in there, and chew him up. And that's what happened. Other traders figured out, hey, Amaranth has this huge position out there, let's go get him. And they went and got him. So when Amaranth went to get out, just like at Hilton, if you went to go get a sandwich, and everybody here wants a sandwich, and you're the last person, you don't get a sandwich. They're going to tell you, oh, I'm sorry, we're sold out. Well, in the market, unfortunately, that means you can't get out. And that's when you're in the position of, like the Market Wizards guy, crying in the park on some strange woman's lap. That's how that happens. We don't want that to be us. So what we're doing here is building the foundation. Okay, these are ideas, and that's why I'm saying don't worry about writing this stuff down. Let it get into your brain, let it soak in. And when you get on the breaks, don't try and talk about everything that you heard. Just meet people and let it percolate. Because that's when it's going